Welcome to another deep dive. Today, we're plunging into a skill that really separates the enduring pros from, well, the fleeting successes in the fast-paced world of financial markets. We're talking about drawdown control. Now, you might think generating profits is the only game in town, but honestly, surviving the downturns, that's the real secret sauce for longevity. Whether you're an active trader, prepping for a meeting, or maybe you're just curious about how market pros actually stay in the game, this deep dive is your shortcut. We've gone through a stack of sources to pull out the key stuff about this, let's call it unseen enemy. It can eat away not just at your account, but your mindset too.
That's such a critical point. So many people just fixate on the upside,
Right.
But protecting your capital, that's really job number one. We'll break down the mechanics, the sometimes surprising math involved, and the really profound psychological hit that drawdowns can deliver.
Yeah, it's about discipline, right? Surviving whatever the market throws at you.
Exactly. Building that discipline to survive and hopefully thrive.
Okay, so what does this all boil down to? Let's get ready for maybe some unexpected facts, possibly a few aha moments that could fundamentally shift how you think about risk and reward. All right, let's start with the basics then. When we say drawdown, what exactly are we talking about? What's being measured?
Okay, so at its heart, a drawdown is simply a peak to trough decline in your account value, that is. But here's the crucial bit, and it trips people up. It's not just a loss from your starting capital.
Right.
It actually measures the pain, financial and psychological, relative to the highest point your account ever reached. For swing traders especially, holding positions for days or weeks, this metric really captures those big equity swings you feel during volatile times.
Makes sense.
And we tend to look at a few types. There's absolute drawdown, that's the drop from your initial deposit down to the lowest point it hits. Then relative drawdown, which is the percentage loss from that highest peak down to a subsequent low point, or trough.
Yeah.
But for anyone serious about trading, the really big one is maximum drawdown, MDD. That's the single most vital figure, I'd say. It shows you the absolute worst case historical scenario for a strategy. Gives you a real gut check on the kind of pain you might have to stomach.
And this is where the math gets, well, kind of brutal and definitely not intuitive. Most people think, okay, I lose 10%, I make 10%, I'm back even. But it doesn't work like that, does it?
No, absolutely not. And this asymmetry, this nonlinear recovery, it's precisely why protecting capital is so incredibly important. If you have, say, a 10% drawdown, you actually need an 11.1% gain just to get back to square one.
Seems small, but...
It seems small, but it gets crippling fast. A 20% drawdown, that needs a 25% gain. A 30% drawdown requires almost 43% back. And the killer, a 50% drawdown means you need a staggering 100% gain just to break even.
Wow, 100%.
Yeah. We call it the mathematical trap. It doesn't just wipe out your past profits. It fundamentally resets your capital base much lower. It completely destroys your compounding power. It just hammers home why cutting losses small is, mathematically speaking, far superior to chasing huge returns that come with the risk of those deep, deep drawdowns.
So it sounds like drawdown gives you a much more sort of personal look at risk compared to something like standard deviation, which we hear about a lot.
Definitely. Standard deviation or volatility, it measures the total spread of returns, right? Treats the ups and downs equally. It gives you a broad sense of price variation.
Yep.
Drawdown, though, it focuses laser-like on the negative side, just that peak to trough decline. It directly answers the question that really matters to a trader. What's the absolute most I could have lost, historically, from my account's high point?
Right, the worst pain point.
Exactly. And for swing traders, anyone with shorter time horizons, you don't have decades to wait things out. Drawdown measures the actual historical stress a strategy went through. It makes risk feel much more tangible, much more relevant.
Okay, that makes a lot of sense. So, moving beyond the pure numbers, drawdowns seem to wage this profound war on a trader's psyche. People often say repairing the emotional damage is way harder than getting the money back. What's actually going on inside our heads?
Well, it's really a battle on two fronts. We need to distinguish between what you might call a technical drawdown and an emotional drawdown.
Okay.
A technical drawdown, look, that's just part of the game. It's a statistical certainty if you trade long enough, the cost of doing business, essentially. An emotional drawdown, though, that's different, that's usually self-inflicted.
How so?
It happens when you abandon your plan. Maybe you start over-trading, trying to make the money back fast, or revenge trading, getting angry at the market. You're desperately trying to erase that initial technical loss, and you just dig the hole deeper. It often starts when a financial loss feels like a personal failure. It triggers this This avalanche of mental noise, self-doubt, frustration, panic, it just clouds your judgment. And there's research suggesting the brain processes these trading losses in the same areas that handle physical pain. It feels real.
So when you're caught in that emotional spiral, what are the sort of demons or cognitive biases that push people towards bad decisions?
Oh, there are a few classics. The biggest one probably is loss aversion. Behavioral economics tells us the pain of a loss feels roughly twice as strong as the pleasure of an equivalent gain.
Right, I've heard that.
So what happens? Traders hold on to losing positions way too long, just hoping they'll come back. Praying, basically. And they cut their winning trades way too early because they're terrified of giving back profits.
Yeah, sounds familiar.
The second big one is revenge trading. After a few losses, you get this impulsive urge to get even with the market, like it's personal. So you take these huge, low probability bets, and a small loss quickly becomes a disaster.
And the third?
And the third is just plain old ego, the need to be right. It stops traders from just accepting, okay, this trade idea was wrong, and cutting the loss quickly. That stubbornness lets small, manageable losses fester and grow into really damaging drawdowns.
It's fascinating, too, that it's not just about willpower, is it? There's actual biology involved, the cortisol trap you mentioned.
Yeah, absolutely. Studies show that traders who are in a significant drawdown often have elevated levels of cortisol. That's our main stress hormone.
Okay.
And high cortisol does two nasty things. It suppresses activity in the prefrontal cortex, that's your logical reasoning, impulse control center. And at the same time, it ramps up activity in the amygdala, your emotional fear center.
So your brain is basically working against you making good decisions.
Exactly. Which raises a really important question. How can you make rational choices when your own biology is fighting you? And the answer really is having a pre-committed, systematic plan, something you can execute almost mechanically, bypassing that hijacked emotional brain.
So the antidote isn't trying not to feel anything, but having this rock-solid, non-negotiable trading plan. That's the key to building a resilient mindset.
That is absolutely the core of psychological resilience in trading. Methodological clarity. When you have a system, a process you trust, a loss stops feeling like a personal failure. It just becomes data, a data point telling you something about the market or your setup. It helps detach your self-worth from the outcome of any single trade.
And are there practical things people can do, techniques?
Yeah, definitely. Simple things like interrupting the pattern. If you take a loss, physically get up. Walk away from the screen for a bit. Break that emotional feedback loop. Journaling is huge too. Write down not just your trades, but your thoughts and emotions during the trades. It helps you spot your personal triggers for bad decisions.
That makes sense. Identify the weak points.
Exactly. And probably the biggest shift is focusing on process, not outcome. Reward yourself for disciplined execution, honoring your stops, sizing correctly, regardless of whether that specific trade won or lost. That shifts your focus onto the things you actually can control.
Okay, great. So let's shift gears into tactics. The first line of defense, the most critical action, cutting losses.
Yeah.
It needs to be systematic, not emotional, right? How do we actually do that?
The absolute non-negotiable rule here is your exit point, if the trade goes south, must be decided before you even place the trade. No exceptions.
Removes the heat of the moment decision.
Precisely. It takes emotion out of the equation right when stress is highest. And the main tool for this is the stop-loss order. Think of it like free insurance against a catastrophic loss. You only pay the commission if it actually gets triggered.
Okay, and there are different types.
Yep, two main ones. The stop market order, or SLM. This pretty much guarantees you'll get out, but the downside is potential slippage in really fast markets. You might get filled at a worse price than your stop level. Then there's the stop limit order, or SL. This gives you price control. It won't fill below your limit price. But the risk is if the market gaps down hard past your price, you might not get filled at all. You're stuck in the losing trade.
So which do people prefer?
You know, many experienced traders lean towards the certainty of execution with the stop market. They'd rather accept potential slippage than risk not getting out at all.
Okay, so you commit to using a stop. The next massive question is, where do you put it? Too tight, you get stopped out by normal noise. Too wide, and the loss is too big anyway.
Exactly. It's a balancing act. The placement needs to be logical. It should be at a point where if the price reaches it, your original reason for taking the trade is clearly invalidated.
So not just some random percentage.
Well, a fixed percentage stop, like Always setting it 5% below entry is simple, but honestly, it's often pretty suboptimal. It
Yeah.
completely ignores the specific market structure or how volatile that particular asset is.
Right.
A much better approach is using TERT structure stops. This means basing your stop on actual technical levels on the chart. So for a long trade, you'd put it just below a recent support level or a swing low. For a short, just above resistance or a recent swing high. If those levels break, your trade idea is probably wrong.
Okay, using the chart itself.
Yeah. You can also use moving averages, say the 21-day or the 50-day simple moving average. If a stock's been respecting the 50-day as support in an uptrend, placing your stop just below it makes sense. And another really effective method is using volatility-based stops. Often this involves the average true range, or ATR. This customizes your stop distance based on how much that specific asset typically moves.
Ah, so it adapts.
Exactly. You might set your stop, say, 2 times the ATR value below your entry. This means a naturally wider stop for a jumpy stock and a tighter one for something that moves less. And finally, there are trailing stops. These are dynamic. They move up automatically as your trade goes into profit, locking in gains, but they stay put if the price pulls back. Great for riding trends.
Okay, so that defines when you bail on a losing trade. But it doesn't control how much you actually lose in dollar terms, right? That's where position sizing comes in, the famous 1% rule.
That is the absolute cornerstone, the cardinal rule. Never risk more than, say, 1% to 2% of your total trading capital on any single trade, period. These 3 things, your total account capital, the distance from your entry to your stop loss, and your position size, they are completely interconnected.
How does that calculation work?
The critical formula is position size equals account capital times risk percentage divided by entry price minus stop loss price. So the wider your stop loss in points or dollars, the smaller your position size must be to keep that dollar amount at risk constant, like 1% of your capital.
Ah, okay, so the stop distance dictates the share size.
Precisely. It brings uniformity to your risk taking. It ensures no single trade, even if it hits the stop, can seriously cripple your account.
All right, so once you've got that solid defense, the stop loss, the position sizing, how do you actually go on the offense? It's not just about preventing losses, but maximizing the winners too. That brings us to scaling, right? But crucially, scaling in, not averaging down.
Oh, that distinction is absolutely critical.
Huh?
Night and day. Averaging down means adding more shares to a losing position, hoping it turns around. It's a gambler's move, honestly. It breaks the #1 rule: cut your losses and just throws good money after bad, exponentially increasing your risk on a trade that's already failing.
Right, bad news.
Very bad. Scaling in, or sometimes called pyramiding, is the complete opposite. It's a disciplined, planned way of adding to a winning position as the market moves in your favor and confirms your initial idea.
So you're adding because it's working.
Exactly. The philosophy is commit more capital only after the market gives you evidence that your initial thesis is correct. This actually lets you start with a smaller, sort of exploratory position, which reduces your initial risk.
Okay, so how does that pyramid concept work practically?
Well, you might start with, say, only 1/3 of the total size you eventually want to have in the trade. Then, before you even enter, you define specific, objective, technical milestones, confirmation points.
Like what?
Could be breaking above a minor resistance level, maybe a successful retest and bounce off a key moving average, or clearing a previous important swing high on the chart. As the price hits each of these pre-planned points, you add another chunk, another third, maybe until you reach your full intended position size.
Gotcha, like layers.
Precisely. Layers of confirmation, layers of capital. So if your plan was for 300 shares total, maybe you buy 100 initially when it bounces off the 50-day MA. Then you add another 100 when it breaks convincingly above nearby resistance. And maybe the final 100 when it makes a new multi-week high.
But as you're adding more shares, isn't your risk increasing? How do you manage that?
It does increase your gross exposure, yes, but you manage it dynamically alongside. As each new piece is added, the stop loss for the entire position has to be moved up aggressively.
Okay.
A very common technique is to trail the stop up to at least the break-even point of your previous entries. The ultimate aim is to quickly get the trade into a risk-free state, meaning your stop is at or preferably above your average entry price for the whole position.
Ah, so you're playing with house money, so to speak.
That's the goal. Once you achieve that, it removes a massive amount of psychological pressure. You can let the amplified position run capture more of the trend, knowing your original capital isn't at risk anymore. That's where it gets really powerful.
Okay, so scaling in is offense. What about the flip side? Scaling out for taking profits.
Exactly. It's the mirror image. Scaling out is simply selling portions of your winning trade at predefined profit targets. You don't have to sell it all at once.
Right.
Maybe you sell a third at your first price target, maybe another third at a second, higher target, and then you let that final third run with a trailing stop loss to see if you can catch a really big move, a home run.
What's the benefit of doing that?
It locks in realized profits along the way, which feels good psychologically and reduces anxiety if the market suddenly turns against you. But it still keeps you in the game, participating if the trend continues much further than you initially expected. It's a nice balance.
And underpinning all of this entry, stops, scaling, refining your timing, getting more precise with entries and exits using technical tools.
Yes, absolutely. Proactive risk management really starts with pinpoint entries. And candlestick patterns can be incredibly helpful here. Take the hammer, for instance.
Okay.
It's usually a bullish reversal pattern. Small body near the top of the range, long lower shadow or wick. It shows sellers tried to push the price way down, but buyers stepped in strongly and brought it back up to close near the open.
Where do you look for it?
It's most reliable after a clear downtrend, especially if it forms at a known support level. Confirmation is key, though. You want to see the next candle trade, and ideally close above the high of the hammer candle itself. Your stop loss then goes logically just below the low of the hammer shadow.
That makes sense. What about oscillators?
Momentum oscillators like the Relative Strength Index, RSI, are great for avoiding traps and confirming moves. RSI measures the speed and change of price momentum on a scale of 0 to 100.
People talk about overbought, oversold, right? Above 70, below 30.
They do, but relying solely on those levels can be tricky, especially in strong trends. A better use for swing traders is often confirming trend-following entries. For example, in a solid uptrend, if the price pulls back and RSI dips into the 40-50 zone and then turns back up, that can signal a good lower-risk spot to buy into the trend continuation.
Okay, not just simple levels.
Right. But probably the most powerful way to use RSI for precision timing is looking for RSI divergence. This is often a leading indicator. It happens when the movement of RSI diverges from what the price itself is doing. It signals a potential shift in momentum is underway.
How did that work?
Well, for regular bullish divergence, you might see the price making a new lower low, but the RSI indicator makes a higher low simultaneously. This suggests that the selling pressure, the momentum behind the down move, is actually weakening. A potential bottom and reversal could be near.
Interesting. And there are other types.
Yes, there's also hidden bullish divergence. This occurs within an existing uptrend. Price makes a higher low, a normal pullback, but RSI makes a lower low. This sounds counterintuitive, but it often signals that the pullback is likely over and the uptrend is ready to resume. It's a continuation signal. And of course, there are bearish versions of both regular and hidden divergence too. Spotting these divergences can give you really high probability entry signals because they show when the underlying momentum is out of sync with the price action. Helps you avoid chasing moves that are about to fizzle out.
Wow, okay. So bringing this all together, it's clear these elements, the psychology, the stops, the sizing, the scaling, the timing tools, they aren't separate tricks. They have to form one cohesive system, right?
That's exactly it. They are all just components of a single integrated system designed specifically for drawdown control. The truly successful trader weaves all of this into a comprehensive, written, and crucially non-negotiable trading plan.
Written down.
It's absolutely written down. This plan becomes your operational blueprint. It guides every single decision, especially when you're under pressure or feeling emotional. Let's quickly walk through the key elements you'd want in that plan for a typical swing trade. First, macro analysis. What's the big picture? Is the overall market trending up, down, sideways? Trading in sync with the broader market generally improves your odds. Second, setup identification. What specific technical pattern or confluence of factors are you looking for? Maybe it's a stock in a clear uptrend pulling back to its 50-day moving average, which also lines up with a horizontal support level, and then it forms a bullish hammer candle right there, maybe confirmed by some bullish RSI divergence. That's a high probability setup.
Okay, finding the specific opportunity.
Right. Third, your entry trigger. Exactly how and when will you get in? It has to be precise, objective, using our example. Enter long one tick above the high of the hammer candle on the following trading day. No ambiguity. Fourth, stop loss placement. Where's the logical point that proves the trade wrong? Maybe one ATR unit below the low of the hammer candle. Fifth, position sizing. Based on your 1% rule, if you have a $50,000 account, your max risk is $500. If the distance from your entry to your stop is, say, $2.50 per share, then your position size is $500 divided by $2.50, which is 200 shares.
Connects the risk rule to the trade specifics.
Exactly. And finally, trade management and exit strategy. How will you handle the trade once you're in? Will you scale out? Where are your profit targets? Maybe sell half at a resistance level that offers a 3-to-1 reward to risk ratio. Then, how will you manage the rest? Perhaps trail your stop up to break even once the first target is hit, and then trail it below subsequent higher lows to let profits run while protecting them.
It sounds very structured, very deliberate.
It has to be. And this isn't just, theoretical stuff. This is the distilled wisdom from some of the greatest traders ever.
Yeah, like who?
Well, Paul Tudor Jones, legendary macro trader, famously stated, 90% of any great trader is going to be the risk control. For him, being aggressive was only possible because it was built on an even more aggressive foundation of managing the downside.
Control first.
Control first. Jerry Parker, one of the original turtle traders trained by Richard Dennis, gave a very concrete rule they followed. When you have a drawdown, you reduce your positions twice as fast as the drawdown. Think about that. A 10% drawdown from your peak equity means you immediately cut your position sizing or overall risk allocation by 20%. It's a systematic way to hit the brakes hard and prevent a spiral.
That's aggressive defense.
Very. And Richard Dennis himself, through the turtle experiment, proved that even incredibly profitable systems go through long, painful drawdowns. The key to the turtle's success wasn't just the system, it was their unwavering, rigid adherence to the rules, especially that 2% risk limit per trade. That discipline allowed them to survive the inevitable losing streaks and still be in the game to catch the huge, system-defining winning trends when they came.
It's interesting, too. You mentioned Charlie Munger. His perspective is different, right?
Right, and it highlights the importance of time horizon. Munger, the quintessential long-term investor, has said investors need the temperament to sit through 50% or even greater declines in their portfolio without panicking, because over decades the market recovers. But what's fascinating is how that contrasts sharply with a swing trader. A swing trader operating on days or weeks simply cannot afford to endure those kinds of deep drawdowns. Their strategy and risk management must be different, much tighter. It really shows how risk tolerance is tailored to your specific approach and time frame.
Okay, so wrapping this up, what does this all mean for you listening, whether you're thinking about trading or just fascinated by complex systems? We've really seen that market success isn't just about hitting home runs. It's fundamentally about disciplined survival.
Precisely. Drawdown control isn't just one technique. It's more like a holistic superpower, if you will. It blends together a defensive mindset, a really deep understanding of your own psychology, and a robust toolkit of systematic strategies, stops, sizing, scaling. When you truly internalize how much harder large losses are to recover from mathematically, you automatically start prioritizing capital preservation above almost everything else, which raises an interesting question.
Yeah. What stands out most to you personally about how these really top professionals manage to navigate both the psychological minefield and the brutal math of trading drawdowns? It feels like that journey from just speculating to becoming a professional trader is paved with this kind of discipline.
It absolutely is. And ultimately, remember, the goal isn't just to make money on any given day or week. The real goal is to live to trade another day. If you rigorously protect your downside, manage your risk, the upside, well, eventually, it tends to take care of itself.
Great final thought. Thank you so much for joining us on this deep dive. Keep exploring, keep learning, and we'll be back soon with another fascinating topic to unpack.